In this section, we're going to discuss emerging business outcomes and really talk about some of the key changes in the business model that we see happening as a partner transitions to a volume-oriented business or subscription-based business, cloud-based business, principally with respect to three things in terms of the number of customer adds that it takes to achieve the same level of revenue and margin, in terms of its impact on services margins overall, and lastly, at a high level, in terms of its impact on cash flow. This is all again to do with the transition to a volume-based business. I want to first of all suggest to you that really this transition to a volume-based business, to a cloud business, to a subscription-based business, however you choose to look at that, is really a fundamental shift, and it really will disintermediate a lot of elements of the existing business model that we've come to enjoy and really reap strong benefits from over the last several years. And this is an example of one of those, of a business really totally displaced. This is a Canadian example. There are likely other examples of this in different industries happening. Well, there certainly are different parts of the world. But this really is dealing with an entity called Blockbuster. It was a movie rental, video rental store, totally displaced really by the advent of being able to watch TV programs, rent videos, that kind of thing online, to the point where physical locations that you had to go to get videos to take back home to rent have totally been replaced by being able to access all of that online and on a subscription basis. And so, Blockbuster in this example, literally closed all of their stores over a period of time as other offerings came to market that offered basically the same thing, just on an online basis. And really the whole point here is that what was once a very viable business model across North America, in fact, Blockbuster video outlets were pretty much on every corner, has in a relatively short space of time been totally really driven into obscurity by being able to access the same kind of thing online, and entirely new business models have sprung up that provide the same basic service just online as opposed to involving physical storefronts at all. Now I'm going to share with you some key differences based on publicly available data, and I'll explain the other sources of data in a moment, but really some key differences in terms of the business models as it relates to new subscription-based, volume-based, cloud-based business models versus the traditional business model that we operate today as software resellers, as Microsoft Dynamics partners. Just a word, first of all, in terms of the data sources quickly. All of the data in the slides that you'll see in the next section really come from publicly available data. Publicly traded companies obviously file annual reports and are required by law to make certain filings. SalesWorks as a company also maintains a database of really over 100 Dynamics VARs and ISVs worldwide. And so a lot of the data that you see in these next few slides come from that database as well. And finally, SalesWorks has built over the course of the last several years, as we've assisted companies in their partners in their transition to a volume-based business model, we've developed a number of financial modeling tools that help people really plan in advance what the financial consequences of that transition are going to be, and make sure that the transition is as smooth and painless and financially rewarding as possible. And there are two key tools there that I'll be using data from in this next set of slides. One is the P&L transition model that really just looks at the change in a partner's P&L as it transitions to a volume-based business, and the second is that of the cloud pricing matrix. And there's more data available on the pricing matrix in particular in other sections of this webinar series. I think really the first thing to understand is that the shift to a volume-based business is not about services anymore as the core driver, or really one of the core elements of the business model that as partners, whether VARs or ISVs, we operate today. Really the transition to a volume-based model is all about product and about a lessening reliance on services. And the data I've explained comes from publicly available sources, security the exchange filings and the like. We're taking 4 examples, so really across the top, Salesforce, NetSuite, RightNow, all of which you'll be familiar with, no doubt. And in the final column, VAR, this is the average VAR in our database here at SalesWorks. The average VAR is about $6 million in annual revenue, just over 5, well, in fact, exactly 5% in EBITDA. And you can see that I've highlighted 3 particular rows here, being the services to subscription or services to software ratio, the software or subscription gross margin, and the services gross margin. And I want to point out some key differences between the 3 business models that you see really represented on the left side columns, that is Salesforce, NetSuite, and RightNow, and the VAR business model you see represented on the far right-hand column. The first thing that you'll notice is that the services to software ratio for a volume-based, subscription-based, cloud-based business is far lower than is the case for an average VAR today. So for an average VAR today in SalesWorks database, nearly for every dollar in licenses that they earn in the way of revenue, they are earning $2 in services. You can see that drops dramatically. So in the case of the volume-based or cloud-based players, for every dollar in licenses or subscription, software subscription that they get not $2, but something between 6 and 24 cents. So there's a dramatically lower mix of software to services in cloud-based or volume-based businesses. Now, the really good news part of that is that increased portion of software over services results in a far higher level of gross margin for the software. You can see that the gross margins on a software basis that the 3 companies on the left are earning are significantly higher than the returns or than the margin that the average VAR, or for that matter even an ISV, will be somewhat higher than 30.4%, but still nowhere close to the levels in the upper 70s and even 80% ranges of gross margins that are available to more or less pure volume players that are really in the cloud in this case, but they're really volume-based businesses and subscription-based businesses. And the last thing that I'd point out in terms of the differences between the business model is that whereas the average VAR today of necessity really has services margins that are far higher than those you see in the volume-based or subscription-based space, it's simply necessary to have those services margins that high in order for the business to remain viable. But as one transitions to more of a volume-based model, the ratio of services that you will expect to receive relative to the income revenue that you will get from software, from your own IP, most particularly, you will get far fewer services dollars for every dollar of software or subscription that you sell. And it's likely that as we progress in time, services margins, and there's more detail coming up in terms of the impact that we're already seeing on services margins, but it's likely that services margins will continue to decline because it is really structural to the volume-based business model, which again is far higher reliant on software than it is on services. So fundamentally, the first thing really to understand about the volume-based or cloud-based or subscription-based business model is that it is about product and not about services. Now the second thing, really just to reinforce the commentary of the earlier slides, is that this shift from product, or rather from services into product, really drives out, because the margins available on software are so much higher than they are on services, really drives out a higher level of combined gross margins. So if you look at the margins available from software and services combined, you'll see again that the volume-based businesses on the 3 columns on the left achieve a significantly superior, in some cases almost double, the level of gross margin combined basis that the average VAR, or for that matter the average ISV, would today. So the whole point of making this transition to a volume-based model, shifting more to selling products than services, is that you earn as a result a higher level of gross margins. And really the last thing to understand in terms of key differences between the emerging cloud or volume or subscription-based business model is that sales and marketing are far more critical to the business than is the case for the average VAR or ISV today, the average Dynamics partner. The average VAR in this example in Salesworks database, in our database, spends a total of roughly 11% of revenue on combined sales and marketing. Now, ISVs spend a little bit more than that, actually, closer to 12.5–13% of their revenue on sales and marketing costs. Whereas the volume players that you see on the left there spend significantly more. Now, that in large part is because they're seeking to drive rapid share gain. There's really two reasons for it. The first one being the desire to grow market share rapidly and to get a position of dominance and prominence really in their chosen markets, which makes it harder for them to be displaced by competitors, and that drives out superior valuations, which you see at the bottom. The valuations that are available to volume-based businesses are very high indeed relative to the valuations that are available for the business all up to either today's standard VAR or ISV. So getting to a position of market prominence in a relatively short space of time is important, and in order to do that, these volume-based players spend significantly on sales and marketing. Now, I want to reinforce an important point, and that is that today's Dynamics partner, whether it's a VAR or ISV, does not have to spend the level of money that you see being spent by Salesforce NetSuite right now, for the simple reason that a lot of the expenditure in those examples goes to building a brand. Some of it for sure goes to directly acquiring customers, direct demand gen, but big portions of it go first of all to creating the brand. And there is no need, because Microsoft is already the second most recognized brand in the world and has been for a period of time. There is no need for a VAR or an ISV today to spend to create a brand, because that brand is already created in the form of Microsoft, and really you're drafting off of that in a way from a brand recognition perspective. Still have to build, a market for your own individual product, your own individual IP, and that, to be sure, will require a level of commitment and resources to the disciplines of sales and marketing that is in excess of what you spend today. A bit more detail on that in a few moments. But you don't have to certainly contemplate the levels of spending on sales and marketing that the existing players that have achieved a level of success in the volume or subscription or cloud game do. Well, let's just talk about the current state really in the Dynamics ecosystem, and this again is from Salesworks partner database of over 100 individual partners worldwide. I introduced this on a slide on a couple slides ago, but just at a high level, in our database there are a great variety of different size individual VARs and ISVs, Dynamics partners, ranging in revenue really from over 17 million to as low as 1.5. And they all have sort of different financial metrics associated with them, of course. But the column you see highlighted on the right is that really of the average VAR, which I've introduced earlier, about 6 million in revenue, 5% in EBITDA, all of the other operating metrics that you can see there. Now, I'm going to contrast that in a moment with what we think will need to be the case for a transitioned or for a transitioning efficient volume player. So in the previous slide, I introduced the current average VAR in our database here at Salesworks. You'll see that on the left-hand column there. And I also mentioned earlier in this section the fact that we have done and built extensive modeling tools that allow us to really look at on a fairly detailed basis how the business transforms itself and how it migrates to a volume-based business. And based on those various models and the projections and modeling that we've done, as well as the experience that we've had in terms of, if you will, calibrating those models, working with partners who are actively involved in becoming volume volume-oriented players. Here's what we expect the volume player, the efficient volume player, to look like. First of all, we expect it to be a larger entity, probably somewhere double in size to the current average VAR. We expect it certainly, in order to get the efficiencies of scale and the economies of scale needed, to be earning certainly over 10 million in annual revenue. We expect EBITDA to be higher, and we expect that for a few reasons. Even though the services to software ratio, you'll see sort of moving down the rows there, we expect to be significantly lower. That is dropping from about $2 in services for every dollar of software today to probably 30 cents, as low perhaps as 30 cents in services for every dollar in software or subscription-based revenue. We expect that the software gross margin, for reasons that we've discussed in the section just or a few slides ago rather, in terms of experience from existing volume-based, cloud-based players, we expect that the software gross margin level will rise significantly to perhaps even as much as double what is the case for the average VAR today. We expect that services margins will drop somewhat as we focus more on building a product-oriented volume business and less on building a services business. Also, perhaps as we fold into the subscription price some services that we don't charge directly for upfront. Today's volume customer is just having less and less appetite to consume the levels of services upfront that they once did. We expect that the utilization equation will increase because we expect that we'll be able to use resources more effectively, fewer resources actually, to do the same levels of volume because of standardized product, because of standardized implementation templates. Really, the volume game is about standardization at the core of it and repeatability, and as that standardization and repeatability becomes greater, we expect that the number of hours that a billable resource can bill in the course of a year will increase in this modeling example by as much as 20%, so going from 1,000 a year to over 1,200. We expect that the cost base will drop as well. Today's average cost per billable resource for the VAR community in the SalesWorks database is just over $97,000 per year. We expect that you will be able to support the volume-based business with lower cost resources. Again, because the products are standardized, the implementation methodologies are standardized, a lot of the support methodologies will be standardized as well. So we expect that the cost base will drop in terms of the resources needed to support the business from today's level. Different resource configuration. We also expect correspondingly that the charge-out rate that you're able to achieve for those resources will drop as well. That's just a function really of today's customer becoming more and more price sensitive. We expect critically that the number, and there's more detail on just what the equivalence is in a few slides, but we expect that the customer adds that are needed to be successful and really efficient and effective and to achieve the levels of profitability that we see as being possible. Certainly 15 to 20% EBITDA we see as being very achievable. But in order to do that, it's of course more of a volume game, and that means significantly increasing the level of new customer adds. So where today our average, the average VAR in our database adds about 18 customers per year, we expect that will increase significantly over time. Not from one year to another, but over the course of a 3-year period, we expect that the rate of customer adds will climb to the point where 3 or 4 years into the transition to a volume-based business, you'll be adding significant numbers of customers, perhaps on the order of 100 or more per year. We expect that there will be fewer employees, fewer resources, fewer people engaged in a volume business per unit of revenue. And for that reason, we expect that the revenue per employee will rise. Today's average revenue per employee, if you take just total revenue divided by total employees in a partner business organization, it's around $170,000, a little bit more than that. We expect that will rise significantly to pretty close, in all likelihood, to $250,000 to $300,000 And this will vary depending upon what part of the world you're in, but the point is that there will be significantly fewer people involved in the organization, in the volume organization, per unit of revenue generated. We also expect that the average new deal size will be lower. Principally because you're not getting the level of revenue up front from either services, most particularly. Recall we were talking about the services to software ratio declining, so you're getting fewer lump sum payments for services up front, as well as fewer payments for licenses. You're taking that on a subscription basis. Even if you take the subscriptions annually in advance, as we've described in another section on promotional models, we nonetheless expect that the average new deal size will drop. We expect that the sales productivity equation will have to rise in order to support the volume-based business. And we also expect, quite frankly, that the average that in a transition state to being an efficient volume player, a VAR and ISV will increase the level of sales and marketing expenditures that they experience today, to probably something in the order of 15 to 17% of revenue, as opposed to obviously a far smaller number, under 11% today. So we expect those key differences to occur as we transition from our current sort of business model to become an efficient volume player.